Forget spending years trying to learn Python, forget the complex math, the endless debugging, and that feeling that the world of quantitative finance is locked behind a door you just can't open. For way too long, the incredible power of algorithmic trading was reserved for giant institutions or people with computer science degrees. That's over. What if you could build and deploy a live trading bot that bets on market volatility, using only drag and drop? What if you could turn your trading ideas into automated strategies without writing a single line of code? Today, I'm going to show you exactly how to go from zero to a fully functional trading bot, and we're going to do it right now. We'll set up a platform, design a real volatility strategy, lock in strict risk management, and backtest it on historical data to see if it actually has an edge. By the end of this, you'll have the exact framework to build your own automated trading systems. The old way versus the new way. To really get why this is such a big deal, let's talk about the old way of doing things. Traditionally, if you had a great trading idea, say a strategy to cash in on big market swings, you had two options. You could execute it manually, which meant being glued to your screen all day, making emotional decisions, and messing up your orders. Or, you could automate it, but that meant learning Python or C++, fighting with exchange APIs, setting up a server, and spending weeks, if not months, turning your simple idea into thousands of lines of code. The barrier wasn't market knowledge, it was a massive technical wall. This kept countless brilliant traders out of the game. Now welcome to the new way. The rise of no-code platforms has completely smashed that wall. These platforms give you an intuitive visual interface where your trading logic is represented by blocks you connect together. Instead of writing code, you drag, drop, and link these blocks to build your strategy, kind of like building with Legos or drawing a flowchart. All the complex stuff, indicators, entry conditions, risk management, is a pre-built component. This puts the power back into the hands of the trader, the person who actually gets the markets. The focus shifts from how to code to what the strategy should be. This isn't just an improvement, it's a revolution for retail traders. For this tutorial, we're going to use a platform I'm calling Algo Canvas. It represents a new breed of visual strategy builders that are popping up everywhere. Think of it as a blank canvas for your trading ideas. Real-world platforms like TrendSpider let you build strategies by stacking condition blocks, while others like Composer let you write your rules in plain English. The main idea is the same. Turn your ideas into a working bot without needing to be a programmer. When you first open a platform like Algo Canvas, you're not greeted by a scary black screen demanding code. You get a clean, visual workspace. On one side, you have your toolbox, which is filled with everything you could need. Real-time price, feeds for stocks or crypto, a huge library of technical indicators like RSI and Bollinger Bands, and most importantly, logic blocks. These are the words of your strategy's language. If, and, is greater than. On the other side, you have your canvas. This is where you drag those blocks and connect them to create your workflow. The platform then takes this visual map and translates it into code that can execute trades for you. It connects right to your brokerage account. Many integrate with major brokers like TradeStation or Alpaca, so when your bot decides it's time to trade, it just happens. This whole setup is built for speed. Speed of creation, speed of testing, and speed of deployment. What used to take months of coding can now be prototyped in a single afternoon. Section 2. Step-by-step bot creation. The volatility straddle. Alright, let's get our hands dirty and build our first bot. We're not just building any bot, we're building a strategy a real quant fund might use, a volatility play. We're going to build a long straddle on the SPY, the ETF that tracks the S&P 500. The idea is simple. We don't care if the market goes up or down. We are betting that it's going to move big in one direction. A long straddle means buying both a call option and a put option with the same strike price and expiration. This strategy makes money from a large price swing, making it a pure bet on volatility. Step 1. Defining our universe and entry trigger. First, we drag the instrument block onto our canvas and pick SPY. This tells our bot we're trading the S&P 500. Next, we need to decide when to get in. We don't want to hold a straddle when the market is flat. That's a guaranteed way to lose money as the option's time value decays. We only want in when we expect a big move. For this, we'll use a classic volatility indicator, Bollinger Bands. So I'll go to my toolbox, find the Bollinger Bands indicator, and drag it over. I'll stick with the standard settings, 20 periods and 2 standard deviations. Now I need some logic. I'll grab the price block and a crosses below block and connect them to say, if the price of SPI crosses below the lower Bollinger Band, this is our signal. A drop below the lower band often comes right before a sharp rebound or a huge leg down. Either way, it signals a spike in volatility, which is exactly what our straddle is designed for. Step 2. Building the straddle. Now that we have our trigger, we need to tell the bot what to do. In our toolbox, we find an execute trade block and connect it to the true output of our condition. Inside this block, we set up the actual trade. We're buying options, not the stock, so we'll configure it to buy 2 contracts, one at the money call option. This pays off if SPY rockets up. One at the money put option. This pays off if SPY tanks. By buying both, we've created our straddle. We're now ready to profit from a big move, no matter which way it goes. Step 3. Crucial risk management. Now for the step that separates gamblers from actual traders. No strategy is complete without a solid exit plan for when you're winning and when you're losing. First, the stop loss. A straddle loses money if the price goes nowhere. We need to decide the absolute most we're willing to lose. I'll drag over a stop loss block and set it to 50% of the total premium we paid. If the combined value of our options drops by half, the bot automatically closes the trade. This hard rule stops a small loss from becoming a disaster. Next, the take profit. We need a target for our wins too. I'll add a take profit block and set it to 50%. If our options value jumps by 50%, the bot sells everything and locks in the gain. This forces us to be disciplined and take money off the table instead of getting greedy. Finally, position sizing. We can't bet the entire farm on one trade. Inside our execute trade block, we can set a rule that this trade should never use more than say 2% of our total portfolio value. This is a core risk management technique hedge funds use to make sure no single trade can ever blow up their account. And just like that, with a few clicks, we have a complete trading strategy. We have our instrument, SPY, our entry signal, Bollinger Band cross, our action, a long straddle, and our risk rules, a 50% stop loss, a 50% take profit, and a 2% position size. So, we've built a bot. It sounds professional, the logic seems solid, but here's the million-dollar question: does it actually work? This is where these no-code platforms really show their magic, with a feature called backtesting. Backtesting is just testing a strategy on historical data to see how it would have done in the past. It's our financial time machine. We can run the strategy we just built over years of SPY's price history. With one click of the Run Backtest button, the platform simulates every single trade our bot would have made over the last year, 5 years, or even more. It follows our exact entry rules, stop losses, and take profits. A few moments later, we get a detailed performance report. This isn't a guess or a hunch. It's data. The report shows us the key metrics: total profit loss, the bottom line. Did we make money? Win rate. What percentage of trades were winners? Profit factor. The total money won divided by the total money lost. Anything over 1 is a good start. Max drawdown. This one is huge. It's the biggest drop your account took from a peak. It's a raw measure of how painful the strategy can be. Average win versus average loss. Are our winning trades much bigger than our losing trades? You want them to be. Looking at the results, we can see how the strategy behaves. Maybe it did great during the chaos of 2020, but got chopped up in a quiet market. Maybe our 50% stop loss was too tight, and we got knocked out of trades that would have turned into winners. We can then go right back to our canvas, tweak the parameters, maybe change the stop to 60% or use a different indicator, and run the backtest again in minutes. This rapid loop, build, test, analyze, tweak, is what professional quants do all day, and now it's accessible to everyone. Once we've backtested our strategy and we're happy with its performance on paper, the final step is to take it live, but we're not going to throw real money at it just yet. The smart next step, and one that every good platform encourages, is paper trading. Paper trading means you deploy your bot in the live market but with fake money. The bot gets live data, makes decisions, and executes trades just like the real thing. You can watch how it performs in real time, see how it handles today's market, and make sure it's working as you designed it. It's the final stress test before you put capital on the line. Most platforms will have a simple toggle: one for paper trading and one for live trading. After a few weeks or a month of successful paper trading, and only when you're 100% comfortable, you can flip that switch to live, and there you have it. We went from a simple idea about market volatility to designing a complete, algorithmic strategy, setting precise risk rules, proving it with historical data, and deploying it live. We went from zero to a functioning, hedge fund-style bot, all without writing a single line of code. The trading world is changing. The advantage no longer belongs to just the coders, but to those with creative ideas and the right tools to bring them to life. The power of algorithmic trading isn't locked away in some ivory tower anymore. It's here, it's accessible, and it's waiting for you to drag and drop your way to a smarter, more disciplined way of trading. If you want to start building your own automated strategies, check out some of the no-code platforms available today. Many have free trials or demo accounts so you can get started. And if you want to see more videos where we build and test different quant strategies, from momentum to mean reversion, make sure you subscribe and hit that notification bell. Let me know in the comments what kind of strategy you want me to build next.